for the first time we're going to an Apple quarter where it looks like that things are sold through and the stock's not at its 52-week high. What a gift.
Yeah, got a couple reiterations of Apple on Friday from Morgan Stanley. And then today on Microsoft out of Goldman, reiterate buy 400, Jim. We're going to be reminded of the reasons we bought these names.
Or sold them. Or sold them. I mean, you look at Microsoft and someone could say, I'm not going to pay 30 times earnings. Or you could look at someone and says, the reason why I've been buying this company is it keeps beating earnings. But was that, David, no longer important when the stock's down 60 from its high? Now we've got a new metric, and the metric is I really want to get out ahead of you. I mean, this is like when you go, hey, the Bears chasing me. I don't know
how widely owned Microsoft was, and every hedge fund is in this name. All of them somehow underperforming anyway. But
okay, so again, are you going to get in at 273?
I don't know, Jim. Listen, the performance last year was extraordinary. The top line growth for a company that's been around as long as Microsoft was eye popping when you would look at those releases. I don't know what we're going to get this coming for the last reported quarter when we get it later this week.
I agree.
One would expect it'll be quite strong again. But you tell me. Let's just go back to the fundamentals. I don't know. Where's this thing trading on
30 times earnings?
Okay. Probably deserves that, given if it can maintain that kind of top-line growth.
That's the problem. So you take it, again, I'm playing this devil's advocate line because I don't like selling it's for the sake of beating someone else. Okay, so Google, Alphabet, it probably sells it at 20. It's 22 times earnings. Back out the cash. What are you talking about now? 19 times earnings. Now, is that expensive? And the answer is no. But you can then, Carl, say, who cares about whether it's expensive? And the answer is that 3 months from now, you'll be carrying a great deal because you're looking. Money is not going to come out of the market to 1.2% CDs. It's going to look for situations where the momentum's come out and the business is good. Every one of the companies that are up there right now is doing things, spending hundreds of billions, tens of billions of dollars developing new programs. And we sit there and we say, well, these are just sitting ducks. And Carl, like the sitting duck thing, well, those are the SPACs. And those are the companies that came public. Those are sitting ducks. And the fact that no one's come in, say, and bought a Lemonade or bought an Upstart. When I say no one, I mean a company. That tells me, all right, be careful there. But I'm not going to sit here and say this is the moment to sell AbbVie. Because even though they're doing well, even though they've got a great yield, even though they're going to have a terrific quarter, I'm going to sell it because, well, everyone else is.
Well, there's
That's
a good example.
Reason.
There's a good example on Splunk today. BTIG ups to buy, target 155. Channel checks improving, lead us to believe companies turning a corner. We see a few dynamics that could help the name re-rate later in the year, specifically the accelerated mix shift to cloud.
No, see, now they're not making money. And my problem there is that I had Doug Meredith on multiple times, and Doug Meredith one day disappeared. I don't know the new interim CEO, and that I find to be, because of that, I'm more concerned. I absolutely like the idea of a turn. But here's a good one, ServiceNow. Okay, so ServiceNow, Adobe, a couple of these, but ServiceNow is now down 200 points from its high. Okay, it sells at 85 times earnings, but it could make the number. That means it's good, except for the fact that it's got momentum buyers. But look at the chart. I know, David, you're not a chartist, but you're repealing whole moves.
Yeah.
Does that matter?
I don't know.
Well, the answer is that.
What is the answer, Jim?
The answer is that if you liked it at 700,
you're going to love it at 500.
Yes.
Okay.
Yes. Yes.
Let's take a look at Snap. If you like Snap at 80, are you going to like it at 30? This morning there's a downgrade from Wedbush to neutral. By the way, they've had an outperform on the stock, so take that for what it's worth.
But
I think what's interesting here is
I'm glad you mentioned that.
Is the thesis, which is Snap currently has a strong foothold in the 13 to 34 demo, and it's all about TikTok. The audience is the most similar to Snap's, which means it puts both Snap's engagement and time spent and ad dollars at risk. TikTok is a power. ByteDance, obviously the owner of TikTok, those numbers continue to soar higher. Advertising, such an important growth component of TikTok, putting Snap at risk. By the way, maybe others too. I mean, there are some who argue short form is really everything that matters for this demographic. They're not even going to be watching television.
No, I watched
in any form.
The Apple ads this weekend seemed like that there were people trying to figure out how to put their TikTok together. I look at Snap and I say the last quarter was terrific. I don't know, maybe it bottoms at 25. Again, I'm stuck with this concept of if you want to buy a stock, you should want to buy it when the stock is not 83 where it was, but 30 where it is. Now, the last hour, that stock could break down to 28, so there's no need to be aggressive. But I'm looking at these stocks down from where they were, and I'm saying, all right, those people who bought it that high, they're wrong. I'm not going to be as wrong as they were. I want to do some buying today. My Charitable Trust is buying today. I'm forcing myself to buy today. We wanted to buy more Friday. We couldn't. Why am I doing it? Because that's what I do. That's my discipline.